Thank you for joining us on the program. Now, let's begin with the inflation numbers. Was this in line with your estimate?
Good morning, BC. Thanks for having me. Like you rightly said, the inflation figures came out and it was higher by 66 basis points to 14.89% from what we saw the prior months. Really was a bit shy from our own estimates. We had thought it was going to close about 14.95%, but really was still much in line in terms of the fact that inflation has been on a northward trajectory. If you look at the inflation figures that came out, it was more food inflation. Food inflation started by 92 basis points to 18.3% on a year-on-year basis. Interestingly, that's the highest we've seen since January 2018. And we believe that the sustained pressure in food basket really due to the underwhelming harvest season. Also, a lot of security challenges in the northeast or the food producing region of the country. And of course, we can't also discount the lingering effects of the border closure, which has contributed to the supply gap. So we think that this has continued to put pressure on food prices. And interestingly, for core inflation tapered a bit for the month. It came down by 9 basis points to 11.05% year on year. And that is a divergence from the uptick we saw in the prior months. Housing, water, electricity, and other gases and fuel, though they surged upwards, but by and large, core inflation came down. In terms of what we expect for inflation in the month of December, December is the festive period, so we still expect to see a lot of demand in the festive period. And I did mention that harvest has been underwhelming. It's not been as much as we've seen in recent times. So there's still, that pressure is still going to be sustained as we go into the month of December. So inflation for the month of December is still expected to at least move upwards when the figures are released.
So what sort of reaction are we likely to get from the equity and the bond market? Or is it going to be business as usual?
Okay, usually when inflation goes up, it signals something really that things are generally going up. And if things are going up, means purchasing power reduces for consumer. For people that in the manufacturing sector, for instance, input prices go up. And that means some of those prices can either be passed to the consumer. Usually when there's so high inflation as well, the monetary authority usually respond by hiking rates. But because you are in a peculiar situation, this is a COVID period, the stance has been more of a dovish stance rather than a contractionary stance. So we've seen them reduce rates. So we don't expect them to hike rates to be able to tackle inflation. More so that inflation has been more of cost push and not demand push. So really hiking rates might not really solve that inflationary pressure. So do we expect any impact in the equity market? No, from these figures. What has driven the equity market has been the huge liquidity profile we've had in the system and the unattractive yield in fixed income environments. So the equity market is still going to go up, but not because of these inflation figures. And usually when there's high inflation as well, I did mention that monetary authorities usually hike rates. We don't expect them to hike rates. So we don't expect the fixed income market to react to this inflation figure. So it's more or less going to be like status quo. Other factors are going to drive performance and not the inflation numbers that we've seen.
You did mention earlier that we might see, of course, a continuous spike in inflation extend to the month of December. But how long do you think that the inflation will continue to rise? Is this trend likely to continue into the new year, 2021?
Yes, it will continue to the new year, but at some point, we're going to see base effect kick in. And because you have a high base in 2020, so by sometime in 2021, we're going to see that reversal. Also, we also expect the monetary authority to change their approach next year. As we exit recession, we expect they're going to exit recession sometime in Q1 or Q2 next year. And we expect them to change from a dovish stance to more like a contractionary stance. And they might begin to hike rates, might begin to see rates go up next year. We want to tackle inflation. And also to ensure that the unattractive yields in the environment somewhat becomes attractive. So we don't expect to linger for long. When the beginning part of the year, we still expect the inflation rate to go up. But as we go towards the end of the year, we expect base effect to kick in, and we expect rates to begin to taper sometime next year.
But in view of the rise in inflation now, how should investors begin to plan their finances for 2021?
I think it's a very good question. I think for 2020, there have been a lot of unexpected. There are so many things that people didn't plan. And even people that planned, it was really against their plan. And what I would say is that while planning is good, also good to have various scenarios. So while you have a financial plan, it's always good to have a different scenario planning. So you have your best case, maybe your worst case, and your base case. And based on whatever happens, you're able to respond appropriately. I think that's one of the key lessons from COVID-19. And I think finances is very key because finances cuts across different segments. It affects everybody. It affects you as a broadcaster, it affects me in what I do, it affects parents and all that. So planning your finances adequately is very important. I would like to mention that there are so many misconceptions about financial planning. Something that is just for the rich, or is just the same as investment, something that is similar as tax planning or insurance planning. Well, tax plan, insurance plan are elements of the financial plan, but really that's not all to financial plan. And in 2021, initially it might be a bit rough, but I guess if people are able to plan their finances very well, things are going to augur well for a lot of people. Interestingly, for some people, this year wasn't as bad as for some other people. Why? Because we're able to plan actively or plan effectively. And I'll say that in coming up with your financial plan, you have to do like a comprehensive evaluation of your current situation and also your future circumstance as well. You have to gather information in terms of your revenue, in terms of your cash flow, in terms of your investment as well. You need to be able to evaluate your circumstances as well. And based on that, you're able to institute a financial plan. But what I would say is that people should take their investment very serious as they enter 2021. As much as possible, try to get investment that can give you that inflation edge, that inflation benefit. Some people have been investing in the equity market, which is good, but I'll say that invest in justifiable, viable stocks. Invest through a proportional manager as well, because sometimes tides can change. Also, for people that require liquidity as well, you might be able to take some position in money market instruments or money market mutual funds as well to help you plan that liquidity, because it's always good for you to have that liquidity, to have that emergency fund. For this year, for instance, a lot of people lost their jobs. And I think some people were able to probably go through that job loss because they had that emergency fund. So emergency fund is very critical in your 2021 financial plan. Having investment that more or less speaks to your objective is very important. And also tax planning as well is critical in your financial plan as well. Like I did say, it's good to speak to a professional. I think one thing I also mentioned is to have a health plan. They say health is wealth. And in your financial plan, I think it's always good to also have that health plan. Go for a checkup early in the year, and as much as possible, do a periodic checkup as well. So having all this in context, like this said, having various scenarios will help you also be able to adjust perfectly for 2021.
Now, let's get your views on the $1.5 billion World Bank loan. Now, how do you think that loan will benefit Nigeria?
So great question. So the World Bank loan is usually developmental in nature. And this is even quite different from the 1.5 billion budget support loan. And according to the World Bank, this is meant to help social transfer, basic services, and really to provide grants to poor and vulnerable households. So over time, World Bank has always supported Nigeria with some of these kind of loans. And in the work of the COVID-19 as well, some of these loans were given to Nigeria. So I think it's a step in the right direction. It's more or less to help the vulnerable citizens, to help the poor citizens. And I think it's also going to help our external reserve a great deal. So 1.5 billion coming to our external reserve is going to more or less reduce the pressure we've seen in the FX in recent time. So I think it's welcoming. I think it's good. Like I did mention, this is quite different from the 1.5 billion budget support loan. I did mention that is going to be contingent on some certain things. One is on having a unified exchange rate, deregulation in the downstream sector, and also having a reflective tariff. We've seen the federal government done a bit of deregulation in the downstream sector, and also the energy tariff as well. But they are currently working on the unifying the exchange rate. So hopefully that might come through as well. And I did mention it's going to give a lot of support to the external reserve.
Now, part of the criteria is the regulation of the downstream sector, which has seen some level of kickbacks from civil society groups and even organized labor. But does the adjustment of 5 naira reflect the fact that we are yet to see a full deregulation of the oil sector?
Yes, absolutely. So if there's full deregulation, that means everything is going to be based on market forces, demand and supply, and really no government intervention. And Nigeria is currently in a peculiar situation, and while they might want to do a food deregulation, I expect to see some kickbacks by organized labor union. And also, this is like a challenging period as well. People are poorer at the moment. So just to institute that food deregulation might mean that prices might go up. And I guess that's where the kickback is. So I think it's going to be done gradually. So I would say it's not a food devaluation because there's still a bit of government intervention. People really expect that really when the market is in contango that prices are not adjusted like this. But I expect it to be done gradually, like I just said, because of the peculiar situation we're in. This is COVID-19, and really income has not really gone up. Income has reduced. People have lost jobs, and also increasing the price of PMS means that people are poorer. People cannot really afford certain things that they could. And I guess also because of the economic importance of petroleum as well, it costs across almost everything we do. So increasing price of petroleum is increasing prices of almost everything indirectly.
Now, this loan means that our total public debt profile has increased beyond 31 trillion naira. What impact will this have on our GDP per capita? Okay, so I think the major issue is not usually the size of the debts and not just the GDP per capita. So I think what would be good to note is that the debt to GDP ratio for Nigeria is currently about 30%, which seems not to be too bad, but that doesn't say the whole picture. By the time we start looking at our debt to revenue ratio, which is above 60%, I think that's where it becomes alarming, because it means that from every revenue we earn, about 60% is used to service our debt. That means what can be put into productive use or into capex is quite minimal. So in terms of debt to service ratio, that is high. I think that's where we want to watch it. Debt, you did mention about GDP per capita. Nigeria is currently about $2,000, which is not too good. So the GDP per capita looks at the GDP of every nation divided by the population of every nation. And Nigeria ranks about 138. About maybe 180 countries are profiled by the IMF and the World Bank. For countries that are quite prosperous, that number is in excess of $100,000. So it means that every individual is just present about $2,000 on an annual basis, which is quite ridiculous. But if the loan that is coming can be put to productive use, I think it's going to be able to bring out some people from poverty. Like I said, it's meant to help some social transfer as well. So if it's put to productive use, I don't think is a bad thing. And the good thing about IMF loans, they are developmental loans. They are not as stringent as some other loans. While there are terms and conditions attached to rates, in terms of the rate, is not as high as some other loans that you see. So it's quite convenient. And over time, Nigeria has repaid most of the IMF loan they've taken in the past. So it's meant to help the vulnerable, it's meant to help the citizen, and it's meant to more or less spur growth and pull Nigeria out of the current recession that we are in. So I think it's a positive if I'm to answer that question. Now, talking about spurring growth, now, when you put all of this together, how much will this actually pose to our economic recovery, bearing in mind the steep growth projections for 2021? So I think is so these numbers are not 1.5 billion is something, but of course it's not going to solve Nigeria's economic issues. But like I just said, it's going to pull some people out of poverty if it's well administered. So it's meant to be some social transfer. So some people are getting some cash. And really when there is money that is being put in the economy, what happens is that it fuels the economy. There's a lot of transaction that is going on. There's a lot of activity that is going on. There's a lot of productivity that is going on. And that also helps the GDP of the nation. So I think it's good. Of course, it's not going to solve our problem. Those problems were not created in a day or in months. Some of the problems we have, they've been there for years. Some of it because the economy is not yet well diversified in terms of revenue. So this wouldn't solve everything, but it's going to pull some people out of poverty, and it's going to be able to, one, facilitate the recovery and also enhance capabilities of MSMEs in the country. So I think it's good. So should we expect the CBN to react to the call by the World Bank for a more flexible exchange rate?
Yeah, so the CBN, they've adjusted twice this year as well. So with what we've seen in the parallel market in the recent time as well, so there have been some appreciation in the Naira strengthening against the dollar as well. And so we've seen a lot of intervention from the CBN in this regard as well. And we expect the Naira to also strengthen a bit more with this 1.5 billion that is coming on board, which means the external reserve is going to at least get a bit of shock absorber. I don't expect all the problems to be solved in one day. So I expect it's going to be gradual, but I expect the CBN to gradually begin to see that unification or that flexibility that the IMF requested.
All right, just before you go, Balao, let me get your thoughts on your expectations from today's Treasury bills auction and, of course, the bond auction as well. What are your expectations from that?
Okay, great. So there was an NTB auction last week, and we saw a bit of change in narrative for the 1 year. It closed at 3.2. Market participants I thought it was going to close at about 0.08, but it did close higher. For the 91-day close at 0.01, while the 1-2-day close at 0.6%. And market has been bearish since then. A lot of people sign up their position to be able to book at higher yields. For today's auction, we expect to see similar performance. While we don't expect the 1 year to close that high, we expect it to close between 0.5 and maybe 1%. For the 1-2-day, we expect to close between 0.02 and 0.04%. And for the 91 days, we expect to close at current levels, which is about 0.01%. We still expect yields in the NTB auction to really pretty much be not so attractive. And there's also a bond auction today, which is the last of the year. The DMO is going to be raising about 60 billion. It was meant to be 80 billion initially in 15-year and 25-year bond as well. We expect to close slightly higher than where it closed last auction. From last NTB auction, market has been bearish. There's been a lot of sell-off, people trying to position for higher yields. So we expect it to close higher than where it closed at the last auction, but really nothing so significant.
All right, I'd like to thank you, Acting MD at Cordros Asset Management Limited, Balao Aino, to thank you a lot and do enjoy the rest of your day.